Hello and welcome to this Credo Fund update. I'm Damien Yeomans and I lead Credo's UK fund distribution. I'm joined today by Rupert Silver, lead manager of the Credo Dynamic Fund. Rupert, welcome. Credo Dynamic has a flexible style. Can you talk us through the fund's objective and how it's invested?
Hi Damien, and thank you. Sure. The aim of Dynamic is to achieve equity style returns, but without the associated volatility of the market. We do this by blending a combination of equity, bonds and alternatives, and we can invest directly or via other collectives. Unlike a balanced fund, we have a flexible asset allocation. So if we really like the market, we can take risks in all areas of the funds. And if we don't, we can batten down the hatches. It has a sterling bias. It's long only, there's no derivatives, and there's no gearing. The next page just gives our asset allocation. You can see on the left, we've got 47% in equity, 37% in bonds, and 15% in alternatives. Turning to the pie chart on the right, this is our currency allocation. On a look-through basis, we are 59% in sterling, 24% or so in dollars, and then a small tail of other currencies. Since the fund began, the range in sterling has been around about 60% to 85%. So you will gather that we're slightly less positive on the UK markets and sterling at this moment in time.
It certainly holds an interesting mix of assets. How do you achieve equity-like returns with a significant weighting to fixed income?
Thanks, Damien. Moving on to fixed income, yes, it's 37% of the portfolio. We're confident in our ability in fixed income, so this is an area where we like to invest directly. You'll see at the bottom of the slide, the yield to worst is 6%, 6.8%. This is corporate bonds and pref shares. We hold no government bonds, just showing bonds don't need to be boring. The duration chart shows most of the bonds are in 3 to 5 years and under 3 years. These short-dated bonds provide some sort of a cushion in the current environment, but they do give us an attractive yield well in excess of cash. And at the top of the chart, you'll see we have a healthy dose of longer-dated bonds. These provide a slightly higher return, and we'd rather take a little bit more risk via duration than credit risk at the moment. Most of the bonds we buy and hold. Occasionally, however, we do see special situations at the moment. I think in April or so, we bought IAG bonds. This, of course, is the parent of British Airways. The bonds, we spotted a convertible that was yielding a lot more than the other bonds. It looked a little bit of an anomaly and gave a return of nearly 15% for about 2 years. We couldn't see a situation where neither would its shareholders support a rights issue, nor would the government step in and help out. So we took a position here, and just a week or so ago, of course, they did have their rights issue. The bonds moved reasonably materially from a 14-15 yield to about a 7% yield. And we couldn't see in the immediate future what was positive in the short term after that. So we took the opportunity to move on and take a 25% or so profit in a very short space of time. Just turning to the right, you'll see the currency allocation. Most of our bonds are in sterling. It's a sterling fund. That's usually going to be the case, but maybe worth pointing out that we do think it's an attractive space at the moment. Since the word Brexit was mentioned, it's not just equities that have suffered in the UK, it's bonds too, and we think UK bonds offer a great risk-reward payoff.
You mentioned that the fund has a bias to sterling, and it's been a difficult time for the UK equity market. How has the fund been finding opportunities?
Well, although the fund has a sterling bias, we're very happy to invest overseas. International investing gives us access to a wider array of companies that has reduced the extreme volatility found in the UK market. Notwithstanding this, we've found some great opportunities in the small and mid-cap space domestically. Smaller companies can offer outsized returns, and we like to play in pools where less people are fishing. There's less research coverage, and perhaps we can find something a bit different. Team 17 would be an example of that. This company IPO'd shortly after we launched the fund, and it's performed exceptionally well. It's one of our best positions. The graph in front of you shows the percentage return since we invested. It's over 400%. The company is best known for founding Worms many years ago, a game that I played in my youth, but the portfolio of titles has grown dramatically. They've actually got 6 titles coming online in the second half of this year, so we're very positive about this in the short term, really, as well as the long term. And this is the sort of company we found and we'd love to find more of. Turning to the next slide, here you can just see where we are invested in the market capitalization spectrum. The majority of the fund is invested in large companies over 1 billion market cap, but we have quite a nice exposure to the mid cap and a small tail of small caps. The pie chart on the right gives you some color on the geographical bias. You'll see 22% of the 47% is invested in global assets, 19% in UK, mainly directly, and 5% in individual overseas equities.
Many multi-asset funds take a fund of funds approach, whereas you invest a considerable amount directly. Can you tell us where you may consider using collectives?
We love to invest direct. Where we have expertise, we like to back our own judgment and avoid paying extra fees. Emerging markets would be a perfect example of somewhere where we don't have that expertise. Here, we like to look for another manager, a fund manager who's got a good track record, whose philosophy we understand and buy into, and who we think will continue to outperform. If we can't find that manager, then we're happy to use ETFs to get exposure in a liquid and low cost way to a sector or country we want to be involved in. Worth noting, we also like investment trusts. Investment trusts tend to outperform the majority of collective counterparts, and they can also give rise to a very attractive entry point. The slide in front shows 2 charts, both quite similar looking, of companies we bought in March. Worldwide Healthcare Trust and Allianz Technology Trust, both a fantastic long-term pedigree. And you'll see, interestingly, in the March sell-off, the red line shows the net asset value of the fund and the blue line shows the share price. So really, when the market was particularly cheap and oversold, the share price of the fund was actually at a discount to those to the underlying assets. If you like, giving us a sort of double discount and a great entry point for the long term.
How does the fund gain exposure to alternative asset classes?
You'll see we've got 15% of the fund in alternatives. It's a space we like. As yields get skinnier on bonds and markets remain volatile, I can probably see us increasing this in the short term. All the assets we invest in are listed. They have low correlation to equities. Most pay a handsome income, and importantly, we expect this portion of the fund to deliver attractive returns in its own right, rather than be simply there to dampen volatility. We've got 14 holdings, all investment trusts. And you'll see on the right some of our exposures. We have song royalties, we have drug and pharmaceutical royalties, we've got infrastructure, and we've also got a holding in gold. We're not huge gold bugs, but we need to have some lower volatility assets, and we think gold is preferable at the moment to treasuries, giving us a return of close to 0.
Has the fund's positioning changed since the sharp correction we saw earlier in the year at the height of the coronavirus market falls?
Yeah, there have been some changes. We spent a long time going through the financials of every asset in the fund. We ended up selling some of our smaller companies where there was perhaps too much uncertainty or the balance sheets were becoming a little bit stretched. On the left, you'll see we sold Avation, an air leasing company, McKay Securities, which is focused on office. And on the right, some of our buys. We've already referred to Allianz and Worldwide Healthcare, but these are companies that we felt would offer growth irrespective of the environment. And we also picked them up at really good levels.
Finally, in terms of performance, you're ahead of your benchmark and so presumably happy with the way the fund has performed since launch in 2017.
In absolute terms, I'm actually slightly disappointed. The fund's been going for 3 years, but in 10 years prior to that, we were running this strategy in private client portfolios and achieving annual gains of 7 to 10%. We haven't delivered that, so there's a tiny bit of disappointment on absolutes. You've got to play, of course, the cards that you've been dealt, though. And on a relative basis, I'm very happy. The chart in front shows dynamic in the blue and the FTSE all share in the black. You'll notice that we've outperformed in good markets and given up less ground in bad markets. So I'm really happy with the relative performance of the fund and feel we've lived up to our aim of equity style returns, but without the associated volatility. In the next slide, we have our more globally focused benchmark, the IA Flexible Peer Group. It's a slightly trickier hurdle at the moment for a more UK focused fund, but I'm happy to say we're ahead of this benchmark. We've been ahead of the benchmark through most of the fund's life. Okay, the gulf isn't huge, but we've got plenty of time to make that wider.
Thank you, Rupert. That's a perfect place to finish. Congratulations on your first 3 years and the strong performance. For our viewers, thank you for watching. Please remember that the Credo Dynamic Fund is available on many fund platforms, both in the UK and in South Africa. If you have any questions or would like to request further information, please get in touch using the contact details shown. Thank you and goodbye.